Welcome to Trulyfit.
Pat, thank you so much for joining the Trulyfit Podcast. For the listeners who have not heard you on the first 2 or 3 times you're on the podcast, why don't you quickly summarize your bio, what you do in the financial world?
Absolutely. Well, thanks again, Steve, for having me back. I apologize to anyone if I sound a little nasally, a little sick, but So Pat Darby, I'm a certified financial planner. I'm an enrolled agent, a certified tax advisor. 2 companies that I run and help mostly in the online fitness space. We have Darby Wealth Planning. It's a registered investment advisory firm. And our sister company is Sin City CFO, where we do business tax consulting everywhere. And we do virtual CFO work there, tax advisory work, bookkeeping, and tax filing. So we try to be a turnkey operation for online fitness coaches, but also online business owners in general. We try to work with the online service providers. So we're here in Vegas. We work with some content creators, and obviously pretty heavy in the online fitness space.
We'll hit on all things in the financial areas, but let's start on the tax realm. What has changed from 2022, 23, 24, this tax year that both small business owners should know, but also maybe the general public?
There hasn't been a huge change between the last 2 years, 2023 to 20. Obviously, we're recording this February 2024. There haven't been that many big changes. The one that is probably most impactful to people listening is the depreciation, bonus depreciation specifically. It's dropping by 20% each year. So it was at 100%. 2023 it dropped to 80. Now in 2024 we're at 60%. That's going to impact the people who love that TikTok advice about go buy a G-Wagon and write the whole thing off. For most people, I don't think it's going to be as materially impactful. And there's actually discussions, I believe in Congress, I haven't seen where the latest is, to push it back to 100%. So
does that change the way that employers are paying out?
No, it'd be more for the business owner itself that would be impactful for, because it gives you the ability to buy a heavy vehicle and write it off and bonus it as much as possible. The challenge, this is sort of a bit of a side, but the auto depreciation I think is miscategorized dramatically on social media. If the vehicle's heavy, then yes, all of those, that's what gets lost in translation. If it's more than 6,000 pound vehicle, then that bonus depreciation is what everyone is excited about. The problem is when you run into luxury vehicles that are under that, the writing it off is actually horrible. Like if you have a $200,000 or $300,000 vehicle, the depreciation on it is, 20 years to write it all off. Because you get around like 50 or 60K in the first 2 years, and it's like 7K in perpetuity until it's down to zero. So the people who like those super luxurious vehicles that are not heavy, they're usually in for a rude awakening when they sit down with their accountant and find out like, no, you're not bonusing this. Like the bonus is like 20 grand the first year, which is nothing if you just spent like 200 grand on a car.
And leasing it doesn't get you into those same write-offs that you would get just because of the weight of the vehicle, correct?
Leasing actually does help you in a way, because it's based on what you've spent. It's not based on the purchase price, since obviously you're not purchasing. So leasing, you can actually do a little bit better. Again, I'm not a car expert, so I know that leasing comes with a pretty expensive price tag itself. But from a tax perspective, there can be. It's just not dollar for dollar, because there is, I forget the term, it's like a lease exclusion or something. But basically the IRS adds back to your deduction if it's more than, I think, 65K or something like that is what they consider luxury. So if you have one of these very expensive vehicles, the amount that you think you're going to deduct is going to be slightly less, because there's a formula your accountant's going to have to follow. For every dollar over a certain dollar amount, the deduction's lost to some extent. But it's still going to do better than most purchases over a shorter period of time.
I'm obviously not in your world. This is more anecdotal. I don't see the amount of tax returns and people's finances as you do, but in kind of casual conversation, something that seems to be said often, or at least more often than I would think, is that people say, hey, nothing has really changed from year to year between this year and last year. I make the same, I went through the same processes, I had the same sort of business model, whatever. But yet the amount I owe or the amount I receive back from the government was vastly different. Why is that? Should that be the case?
In If you made the same amount of money from at least from 2023 into 2024, in theory, you should pay less because all of the like deductions and things like that are all indexed for inflation. So if you'd made no more, then you'll pay less because the standard deductions and married filing only, those have gone up. And again, they're even talking about increasing some of the child tax credits. So in theory, you'll pay less, but since we work with mostly business owners, that's paying less tax is the goal, but making sure you make more profit is, in my opinion, the more important goal, because tax deductions are just a coupon. So, if you're going out there, depending on your tax bracket, let's just say between federal and state, if you're in a top bracket, if, federal tops off at 37, let's say another, just keep the math simple, 3% for the state, you're at 40%. So going out and spending $50K or $100K on something you don't need, all it did was just give you a 40%, $40,000 deduction. Versus if you didn't need that item, there's no ROI on it. I don't agree with those strategies. That's why, like, looping back to the vehicle, I don't like when people that don't need a vehicle are trying to go buy one, because there's other things you can do. Like,
it's not that these decisions aren't made in a vacuum. They go, oh, look, I can get some money back for this. It's like, okay, but what else could you have spent that money on that could potentially bring money into your company?
Or just open up a retirement account and do it that way, like pay yourself. You still get the tax deduction, but again, you keep the money and defer it taxes to later. And that's really the game. Like, this is where I butt heads with a lot of CPAs that are more old school. Tax planning is not trying to pay less tax this year. Tax planning is trying to pay less tax over a lifetime. And so sometimes you want to strategically pay more because you're forecasting how your business is going to do and trying to forecast where tax rates are going to go, which obviously we have no clue. Like, we don't even know where they're going to be next year or in 2026, but that's the game. The best example of this was Peter Thiel. Are you familiar with him?
I am.
Okay. So for the audience, he's like PayPal Mafia, if I'm not mistaken, where he made his original like big money. But he was smart enough to put a lot of money into his Roth IRA when he was, I guess, getting started in business. So for people unfamiliar, your Roth IRA is post-tax money. So you pay the tax and then put the money in. Now, I don't know. I'm sure he was a top earner and he was probably in California, so his taxes weren't low. But he was fully funding his Roth IRA and he had a lot of money in there. When his opportunity came along to invest in Facebook, he invested through his Roth IRA. He put 500 grand into Facebook as like the seed investor. That ballooned to whatever it is now, 5 billion, 6 billion. And that's all inside of his Roth that'll never pay taxes again. So like, that's the gold standard of tax planning, because he bit the bullet and put it into a Roth IRA. He could have done a traditional IRA and taken the tax deduction, which I'm sure some CPAs are like, yeah, you're in California, you're making millions, take the tax deduction. He didn't, and he will legally avoid taxes on literally billions of dollars. Because like, so that, in my opinion, that's like the gold standard. And that's where you'll get a lot of pushback sometimes with your tax professional, because they'll want to take the tax deduction today. And I don't think that's always the best approach, especially as a business owner, you have to be sitting down in November and looking at what you expect to do next year as well. Because I have this conversation a lot with clients. It's like, okay, we're analyzing your taxes and this is how much money you're going to owe. But you have to look like, what bracket are you actually falling in? If you're a married couple, the 24% tax bracket's pretty big. So you might feel like your business is generating a lot of taxes and it's expensive and you want to like cram a bunch of deductions. But then you look at the trajectory of the business and you're on pace in 2024 to do way better. It's like, don't start swiping your credit card for all the trips and the things that you need in 2024 to lower 2023, when you're likely going to push yourself into the 32% bracket easily in 2024. So those deductions, the exact same expenses that we agree are good for your business, like you need to take that trip, you need to hire that coach, you need to hire that mentor, whatever the case may be, that would be a much more powerful deduction in the future versus now. And that's sort of like, so that's why tax planning is more of an art than a science, or I guess a combination of the two.
Sure.
But I think there's a lot of lazy tax professionals who just try to ring the register this year, and that could be much more costly in your future from a tax perspective.
I wish I came armed with all the specifics here, but I don't know if you know who Ohtani is. One of the best baseball players, if not the best baseball player in the world, just signed a contract with the Dodgers. And what they did was, in order for him to circumvent paying taxes, they basically said, you're going to be making $3 million a year instead of what you should be making, $30 million a year. What we're going to do is, when you are no longer a Los Angeles Dodger, you're then going to move to a different state, and then you are going to get paid $200 million after that official year where you're no longer Los Angeles Dodgers. So like, everyone circumvents these taxes. He circumvents the California taxes, and just shows that like there are ways around the system regardless of how much money you make.
Yeah. I mean, especially since he had a business organization that's willing to play ball. I'm curious. Obviously, they have smart people work in those, but the states are aggressive. So I'd be what team does he play for?
He plays for the Dodgers. So Los Angeles.
So that'll be interesting because California is aggressive. I wonder if they'll try to find a way.
That shows that you know your stuff, because the first thing that came out, upon reading about this, is that the current laws, like as is, allow for him to do this, but that doesn't mean between now and then that California can't change their bylaws somehow and then come after him. So I imagine, because they don't want other people following down his path and California losing hundreds of millions of dollars for all of their athletes who live in the area, that they're going to close this loophole.
Yeah, like as a cautionary for anyone, like if you're sitting there, like, this is a bit of an aside, if you owe the IRS and you owe the state money and you can't afford to pay both, pay your state. The states are way worse to owe money to from a tax perspective or be delinquent with, because they're smaller, they're aggressive, especially if we're talking some of the New York, like the ones that you expect, the New York, the California, the New Jersey. They charge a lot, they're aggressive.
They all have something in common.
What do you say? Yeah.
They all have something in common.
They all share the same color. And so it's, so yeah, like in general, even if you're moving out of those states, don't try to keep a toe in the water, because of exactly like this guy might run into an issue with. If you have a successful business and let's say you're in California and you're coming here to Nevada, or you're doing the Texas thing, whatever it is, make sure you really leave, because they're looking for that. Like, they're looking for people who pretend to leave. Like, they'll do things that, like they'll audit like where your pet is going to the vet, because like if you say you live in Texas but your dog is going to a vet in LA, they're like, that's where you live. Like, people don't send their pet to like a different state that they live in to get treatment.
What is that term when you move like a business, like an LLC, and can't you not do it in certain states? Can't you not move a business to another state?
It's called, domestication, where you physically move your LLC to the new state. And like, not most states allow it, but there are weird rules. So you always have to talk to a lawyer and say, like, what state are you leaving? What state are you going to make sure that there is reciprocity there. But most states allow it. Like, when I left New Jersey and came to Nevada, I did domestication. So what that means for your listeners, everything's the same. Your LLC comes over, your tax ID, your banking, everything stays the same. The only difference is now Nevada recognizes your LLC and you're dissolved in New Jersey. So, but yeah, California is weird with that.
let's stay on that real quick. So let's go ahead and say you're, a virtual personal trainer and you live in South Carolina and you move to Florida midway through the year and you have an LLC. Could you not, and maybe you still own property in South Carolina. Could you not just leave your LLC in South Carolina? Does the LLC have to be where you are physically sleeping at night?
From a tax perspective, so there's two ways to tackle this. From a tax perspective, it should be. There was an article that a law firm gave me when I was living in New Jersey that was called like How to Move to Florida or something like that, New York to Florida. And it was all this case law of business owners. And I think there was like, this one was like three brothers. So it was like a perfect case study of like one moved to Florida the right way, one stayed in New York, and one fake moved to Florida. Like he left some residuals behind. They ended up selling the business for I think like 20, 30 million. So New York was like, we want our cut. The one brother was totally cool. Like he did all the things to get into Florida. The one brother obviously lived in New York. He owed. The other brother that fake left, like he did most of the things. He ended up owing millions of New York state taxes because he didn't fully leave. But to answer your question, you don't need to take your LLC with you. You'll still continue to owe taxes though in that state. And especially it becomes an issue like if you owe them something substantial, like you end up selling your company. Like you're living in Florida, the LLC is still in South Carolina, and you sell, South Carolina is going to expect their cut. But in general, you want an operational business as LLC where you live, because that's the misconception that's out there, especially when you go to form your LLC. That's why I highly recommend people get their LLCs formed by lawyers, not like the big websites where you're basically talking to a customer service person, because they'll put you wherever you tell them, or they'll try to push you into like Wyoming and tell you all this privacy stuff. And the reason I don't like that is because LLCs, the way you think of an LLC is going to be different. Now, I'm not a lawyer, so this is not legal advice, but the way to think of an LLC is really twofold. Is it for investment properties or is it for an operational business? If it's an investment property, like you're buying rental real estate, you want that to be where the property lives, because now you're just talking asset protection. And if someone starts talking about Wyoming or Ohio, where the privacy laws are very strong, that makes sense, because if you own an expensive piece of property, you don't want the world to know you own it. You want to reduce your liability. Conversely, you're running a fitness business, you want everyone to know you have that business. Like you're not hiding. Like that makes no sense to have privacy protections when you want the whole world to know that you exist. So it makes no sense to drop yourself into Wyoming and call it privacy protections for an operational business. And more importantly, if you're living in California and someone told you to go to Wyoming, California does not care that you have a Wyoming LLC. You still owe them all the same taxes, except you've added a layer of complexity, because now inside of California, you have to foreign register your entity there. So now you're just adding more paperwork, and likely now you're paying fees in two states to exist. So, and you didn't get out of any taxes. Like if you're in New York, New Jersey, California, and you're trying to like drop your LLC in Florida, Nevada, all these like low tax states, you haven't solved that. You haven't saved any taxes. You just made your life more difficult.
Let's move on to the audit. Everyone's afraid of the audit. What are things to do that people can circumvent being audited? And I guess on the other end of the spectrum here, what are the things that ignite the red flag for one to be audited?
So if you're audited, I don't do audit work, but one of the things we're always doing is just getting people prepared if they ever are audited, and that's just documentation. And that's going to be, so like the cheapest, best bookkeeping you could ever do is just keep your receipts, have everything organized, because that's the problem with an audit is the onus is on you. The IRS has no burden on their end. It's the only time where it's guilty till proven innocent. They're like, this is what we think your revenue is. And they're getting those numbers from verifiable sources because you're probably getting paid on Cash App, Venmo, Stripe, PayPal, all these things where the IRS can find out in 2 seconds exactly like what you received. So on their end, they're going to say, okay, we know you received 300 grand. So you owe us taxes on 300K worth of income. It's you, the burden's on you to prove, whoa, I only owe taxes on my profit. You have to prove what your legitimate business expenses are. That's where receipts come in. So having actual receipts, and the credit card statement doesn't count because I'm trying to think of a national example, but like 7-Eleven, for example, you can buy anything at 7-Eleven. You could buy gas, you could buy alcohol, you could buy food. So if you're on a road trip for business and you're swiping your credit card at the gas pump for like $50, the IRS has no clue you didn't just go in and buy 2 cases of beer. So that's why the credit card receipt is useless. Or a better example might have been Amazon. Like Amazon sells everything. You can't just show the IRS a credit card receipt that says Amazon. They want to know, like, what'd you buy? Did you buy an office computer? Did you buy, something personal? So that's the main thing, and is the receipts. And then one more component of the receipt is the 1099. We just had that deadline of January 31st. So for everyone for 2023, you have to 1099 your vendors. So it's the same thing. Like if you have a vendor that works for you and you pay them through Zelle, for example, and let's say you pay them $5,000, because Zelle is not a payment processor, they're not going to do a 1099 for you. So that's going to be a critical component of showing the IRS, like, this is by 1099ing them, that's your receipt. They could disallow those legitimate expenses.
Good information. Let's move on to potentially bad information, and that is TikTok finance. I always rail on TikTok fitness. Not that it's all bad, but when you're a professional like Pat and I, there's always caveats because there's so many variables that go into every situation. We like to individualize information. Yes, we have, I guess you would say, overall principles we try to stick to. Pat has them in finance, I have them in fitness, but ultimately we can't always make suggestions for people until we have every single bit of criteria. But this is sort of the TikTok finance that's been floating around, and I just want to get your macro view on this. The one thing is the 50-30-20 rule that goes from necessities to wants to savings. In general, is this a good idea?
I love that. How people break it down, I think, varies. But I think the budgeting concept doesn't get talked about enough, especially recently. I heard an article from Gen Z yesterday that was like, they were saying self-care is more important than budgeting for like buying a home or something like that. And I'm not Gen Z, but I don't understand, like, linking it back to fitness. It's like, well, it's like that same concept, like, well, I cheat on my diet, so with one slice of pizza, so I'll just go ahead and eat the rest of the pizza. And so it's like, well, okay, if things are expensive and inflation's high and buying a home and buying a car is expensive, how is blowing more cash going to help? So I'm all for budgeting. How people do it, whether they use those specific metrics, or like, I'm a big fan of separating things out into variable costs monthly. So I break it down into monthly and non-monthly, and then also variable versus fixed. So in my opinion, everyone each month has fixed costs, like things that you're going to pay for: your cell phone, your home, your rent, most insurance policies, things like that. Then you're going to have your variable, like, which are harder to track, like going to the grocery store, going out to dinner, out for drinks, things like that. Those are both monthly. So you have a ballpark on where you're going to be with those. And then you have your non-monthly expenses, like maybe your property taxes, or even budgeting for things that will come up, but you don't know when. So like for me, since I'm not a big fashion guy, like I put clothes in that bucket, because like, I don't know, am I going to buy like a bunch of clothes in 1 month and then a few months not? Medical, like I could go months or years without going to the doctor, but I put non-monthly budgetary expenses there. So those are the 3 categories that I like to do. How people break it down percentage wise is totally up to them. And I know it's harder. Those percentages are much harder for business owners, because if you get a W-2 paycheck, it's pretty easy to do the math on like, okay, after taxes, you see what your pay stub is, what's left, what are my expenses, what's my income, what's left over. As a business owner, it's much harder because you could end up having a really good year or a really bad year. And so that's why I like to really break it down to like, what do you truly have as expenses?
Moving on to cash stuffing. If you don't know what this is, apparently it just means using cash for everything. That the new generation is saying, hey, I'm going to put cash into envelopes, and that's the cash I'm going to use to purchase things, because if I see the cash in front of me, I'm less likely to use it as opposed to a credit card, which just seems like plastic.
What are my thoughts on that? I personally don't like cash. So for two reasons. One, because I'm just so used to the convenience of swiping a card. But that being said, I like using a credit card for two reasons. One, I get the points. I don't hold a balance. So for me, it's great. I just get the points. I don't pay any interest. But the other advantage of a credit card versus a debit card, for example, and you're just using the cash, is that you have more creditor protections. If someone steals your credit card, working with them to get the money back or getting the charges removed, versus if someone cleans out your debit card account, it's very difficult. And then obviously
or steals your cash.
Right, exactly. Cash, you're probably completely screwed. Debit card, you have a chance, but that's so me personally, I don't like that. Again, also I'm like OCD with tracking things. I track every dollar in the business, in my personal life, because I'll use like apps like mint.com that link to my accounts, and I don't stare at it all the time, but anytime I need to go back and reverse the numbers, like if I'm updating a budget or whatever the case may be, all that data is there. If you paid cash, if you want to go back and do your homework, you have no clue. Like the cash is all over the place. So especially in your business, using cash is a disaster, in my opinion.
I would say that as a budgeting tactic, as a micro budgeting tactic, it could make sense. So let me put this forward to you. Maybe I am 23 years old. I struggle to, not just swipe my credit card at all times. And I'm going to the bar tonight with my friends. So instead of taking my credit card, I just take $80 or $120 or whatever it is that I think I can afford that night, and say, well, it's like gambling in a sense, right? It's like if you only go to the tables with this amount of money, this is the only amount of money I can lose. So now I'm going to take this $80 with me, which now I know I'm only spending that $80.
From that perspective, I do like it. If it's a controlling mechanism or a forced discipline mechanism, then I love it. Like any way that people put financial barriers in their life to help them hit their goals, I'm all for it. How you do it, I personally just don't like cash. But again, I would never discourage someone from something that works for them.
TikTok investing, sticking with percentages, they say 40, 30, 20, 10, respectively, ETF, large cap, growth, and penny stocks. Is this nonsense information or not too bad?
I don't think there's any right or wrong if you're going with a diversified portfolio. When it comes to investing, when I sit down with a client, it's about putting a plan together that will work when everything's going wrong. Because there's a term called the behavior gap. And I don't know if your listeners are familiar with it. It's basically describing what an average index does. Let's just say, for hypothetical purposes, like the S&P 500 historically does 6%. And like I know Ramsey will say higher, but depending on the years you use, but I just use a conservative number. So let's say it does 6%. And then someone sits down and says, well, I'm only averaging 3% and I'm invested in the S&P 500. So what the hell? Usually that difference between the 6 it should have given you and the 3 that you're actually getting is your human behavior. And they call that the behavior gap because that's like you messing it up. Like I can't tell you how many clients have sat down with me and they're like, my 2 best investments were a 401k that they had no access to. They were just, the money was going in, good times and bad. Maybe they even left the job and forgot about it for like a decade. And their second one is usually their home. And often, sometimes the third could be like an insurance policy. And what all of those three have in common is that you didn't have a choice. When things were crappy, you still dropped in your 401k investment. You still paid that month's mortgage. You still had to pay that policy premium or they would have lapsed on you. So really the difference is you didn't deviate from the course when the stock market was really high and like you were like, whoa, maybe it's expensive right now. Or when the sky was falling and you're like, oh my God, the market's going to zero. I shouldn't be here anymore. You still kept the course. So I don't think it matters as much. I think it's probably similar to fitness in that what you do, like there's obviously a million diets out there. None of them are bad if you could stick with them long term. If there's again, I'm not a dietitian, but you get what I'm saying. Like the purpose is the discipline to do it for the long haul. And so if you have an investment allocation that you are comfortable with, you're young, you have the time horizon, you're not going to mess with it when like the next scary thing in the economy happens, then I think it's the right allocation, because that's where people get messed up is they panic buy, they panic sell, and that's when they start making mistakes, in my opinion.
Yeah. Well, part of it is because it's fun. Let's be honest. Like trying to forecast what's going on or judge the market. It's a form of gambling in a sense. So I think people who are on, I don't know, like Robinhood or something, right? And they're using, cryptocurrency. The buying and selling is fun for them. And I think that comes into play, but you have to have somebody who knows more than you about this stuff. And ultimately you have to be humble to know that there's no way outside of luck that you're going to time everything perfectly. It's much easier to just let it ride, and go for the long haul.
Yeah. And in terms of market timing, when I was first introduced to Alex Hormozi, one of the first things I heard him say, which made me love him, obviously now he's even bigger than when I first was starting to see his content. I think he had said something, I wish I could find it. It was a podcast episode where he was discussing that he doesn't believe people should be actively managing their assets. And I'm paraphrasing this. They shouldn't be actively managing their assets until they're worth like $100 million, because it ends up just becoming a distraction to your business. He's like, basically, I forget his math. He was essentially saying like giving people the benefit of the doubt, saying the stock market returns 10%. If you're a kick-ass active trader, maybe you're returning 20. But that extra 10% you gained, how many hours did that take away from your business? And if you put that back, how much more money would that have been if you instead of doubling your investment return, what if you doubled the revenue of your company? And he was saying, do that each year. And that's I think the math that I agree with the most, where it's like, if you have a business, that's one of the best assets that you could put your time into, versus you could put other things, not trying to time an investment and just focus on growing the assets that are most under your control, meaning your business.
Whole life insurance and borrowing against it. This has been like a huge social media thing for the last 6 months, to the point where it almost comes off to this like multi-level marketing way where there's like people who push it and then they sell courses and they have other people push it underneath it. Explain what it is, why people do it, and if you think it is a good strategy.
Okay, so excuse me. I feel kind of strongly on this, and I butt heads with friends of mine. So like I have a friend, probably two people that I think in the insurance space share two things: knowledge and ethics. I think the vast majority of people selling life insurance have only one of those. And that's the problem, because most people that I know that are in insurance are really good people, but they're part of a program that's essentially a sales program. It's not comprehensive. They teach you what you need to do to sell. They get you licensed. So they have all the ethics in the world, but they are only as good as what their sales training taught them. And then conversely, you have people that work for companies that, like the big companies, and they really know their stuff, and they'll push things at you that you have no business buying. And so that's the issue in general with that being out there. They pay a lot, like they're called IULs, like, and so Index Universal Life is what you'll see out there a lot. And the concept is good because they're basically saying you put your money into these accounts, it's guaranteed because it's an insurance product. So they can use the word guarantee, and it's going to give you X rate of return, and all of them are different. So make sure you do your due diligence. The rates of return are going to be fixed, or at least have no downside. So you might not get below 0% if the market's at negative 20 and you're at 0. So you're like, all right, that's great. Now you're also capped on the upside. When the market's plus 20, you're getting your 6 or 7, whatever is your policy. And they call it the infinite banking because you can borrow from it in like a participant loan. And so the concept is they'll only let you borrow so much, so the policy will never blow up. And because you're taking a loan, loans are not taxable. So you're banking with yourself until you die, and then the loan gets paid off, and the difference between what the loan was and the death benefit goes to your family. That's the concept. Again, the problem is it's sold by a lot of predatory people. And so there are applications for it. And where I'll butt heads with my colleagues that I think are actually very knowledgeable, very ethical, is the series of events. And that's what I was talking about before. If you're a business owner and you're not fully funding your retirement vehicles, I don't think insurance is the right spot yet. But if you're telling me that you are a very successful business owner, multi 6 figures, 7 figures, whatever the case may be, and you're like, I've maxed out every retirement account, I'm already buying investment properties, things like that, like, where do I put the rest of the money? I don't see a problem with that being a third vehicle because, one, it's got some guarantees to it, which is nice. And two, they're creditor protection. So the more money you make, the more assets you have, having another bucket of money that if, God forbid, you got sued, or if your kids do something that get you sued, like you have this big pot of money that a creditor can't come after. Now I'm on board again. But I think it gets sold too often to young business owners.
It's getting sold to young business owners. And I would even say people who are not even working, right? Like part-time workers, people who lost their job, people who are down and out as this, like, oh, this is your trick to get out of your bad financial situation.
You're 100% right. And I also dislike these a lot because I was sold them before I was in finance. So when I was like 22 coming out of college, I was sold these types of policies. And after 2 or 3 years, when I was explaining to me what I had, I was given two choices. They're like, continue paying forever, which again, I was like 23. I had no beneficiaries. So I could either pay forever or surrender what I had and just, so whatever the couple $1,000 or so that I'd put into it, I just had to walk away from. I literally left with nothing because someone pitched this to me as like a great retirement investment. Again, like if I was putting all that money into 401k or Roth IRA or anything, I would still have it today. So that's what I don't like, is that people that sell these will do the math and say, okay, you're capable of $500 a month forever. And like those infinite banking things that they're going to tell you about, taking out the loans, typically that doesn't happen for 5 to 10 years because the policy needs to be able to sustain itself. Again, like when a policy originally gets written, the company is essentially losing money because they have insurance, they have sales reps that are involved, they have marketing, they have all these internal costs of underwriting. So the insurance company is immediately underwater. And so that's why they won't let you access your money for a certain period of time. That's why for me, I was like 2 years in, they're like, you just have to walk away. Like there's nothing, we won't give you your money back. So that's the other thing that people, I think, get misled with, because they'll hear like, oh, well, 401k suck, I can't touch it till I'm older. But there's a lockup in insurance as well. And two, when it comes to retirement vehicles, it depends what you want to use the money for. Because like you could use your retirement vehicle to buy a company, like Peter Thiel, like we talked about. He bought Facebook with his 401k. So that's one of the things I don't hate them as an investment product, but they're so oversold to people that don't know what they're buying, and there are probably other things that would be less detrimental, just because, like you said, like there's a commitment to it, versus if you start funding your Roth and the business hits the skids, you can just stop funding your Roth. You can't stop funding these policies or they'll lapse.
We always talk about the crossover between fitness and finance. So let's go over a few of those things and how I might deal with it in the fitness world and how you deal with it correspondingly in your world. I might have a client who I have to have a tough conversation with them because they're not meeting their goals due to the fact that they are making bad decisions. So maybe their goal is to lose 15 pounds and get stronger. And we have conversations, every other week and weekly check-ins. And I can tell that they're drinking too much, or that they're off their diet. We have to have these tough conversations. Do you feel comfortable doing that in your position? Not even from just an investment perspective. It might not be somebody who has a lot of money and you're like, hey, I don't think you should invest in that, but from a spending perspective also.
Meaning they spend too much and they keep derailing their plans?
Correct. They're spending too much or in areas where you maybe even for the business, you just don't see it as being the responsible choice, and maybe the sole reason why they're not meeting their goals.
In the beginning of my career, that was a problem. Like clients would come to me and they would say, this is what I'm going to do, and this is my goal. And they were constantly jacking it up. And a lot of that's actually gone away. I don't know why. But that was also, that was in the beginning part of my career when I wasn't working as much with business owners. So now it happens less with business owners, but it's harder for me to articulate why I have more compliant clients now. Maybe because we spend so much time focusing on their goals. You know what I mean? I know fitness is the same way, but I don't set any of my clients' goals. So it's important for them. And so that's what we just try to tie everything back to. Like what they're trying to.
You're saying like they have their own intrinsic motivation to make a successful business and to do these things, and they're hiring you as a professional. They've invested money in you and all these things, so they don't really need sort of a slap on the wrist. They're doing the right things anyway. Right,
but not only that. I mean, when we sit down and build your goals, we can extract those KPIs and put them on reports to clients. So I don't have to. Like, it's literally the top page of the report. Like, you said this is the amount of profit you want. This is what it is. And it says in like big red, like percentages, like this is how much you were off on that. So the good news is most of the clients that are off track, they want to fix it just as much as I do. They're not, it's rarely like self-sabotage. It wasn't like, I'm thankful that I don't have clients like, well, I wanted to make this, but I ended up going on a $30,000 vacation. Yeah. It's usually like, we lost some clients. We hired this person. They're not working out. And so it was never like sabotage. It was like, all right, we got to figure this issue out.
Sure. Well, staying sort of on these topics here, short-term goals sometimes hinder long-term goals. I know you've talked about this in the past. You can elaborate on this with clients. I have to let them know that sometimes their short-term goal, whether it be vanity or maybe they want one particular muscle to pop and they don't understand that. I have to say, well, there's antagonist muscles that are going to be affected by this. We have to make sure that you're well-rounded on both sides. What do you see as like the biggest short-term goal that your clients ask for, or that the general public tries to reach for in the finance world that hinders their long-term goals?
Probably the biggest issue would be, that's why I go back to the vehicle. I feel like sometimes a vehicle screws clients up the most. at least I feel like that's where I'm always trying to talk them out of it. Like if they don't need the vehicle and they could buy an actual asset, or allocate that towards their first home or their first rental property. It's usually the vehicle. And again, I try not to impress my personal, because I'm just not a car guy. So I try not to like put that on people, because I get it. Like some people love cars and that doesn't excite me. But I do try to bring that up when it's like, financially speaking, if a client is not printing money and it's like, well, you're sacrificing X for Y. So that's one. But other than that, I don't have a lot of my clients get derailed by a short-term goal. I think sometimes the problem is for business owners, just the shiny object syndrome. Like, what do you do? Like the challenge I have clients run into is where to invest the money.
Sure.
Because on one hand, like this year, I really wanted to max out my 401k, but it would really help me out to have another junior coach. So that's the calculus that we're looking at. Like, which goal is more important to you? And that gets into like more the CFO world. Like, well, what's the higher rate of return you're going to get here? So but again, that's why I kind of go back to the car thing. That's, I think, the short-term goal that jacks people up if they don't need it, if it's more of a vanity purchase.
Yeah, I mean, I would argue that cars are always a vanity purchase. I don't understand. I mean, I think you can get a 6-year-old car with all the bells and whistles for typically half the price of the new car. And in this day and age, they're just as good, right? So like your 2017 whatever, even like Lexus truck, is going to run just as good as your 2024 Lexus truck. And it's going to run you half the amount.
Yeah. I'm the same as you. I know a lot of people feel very differently about it. That's why, like, I don't push too hard on clients who really want to buy a car, because I realize I'm like, I just don't get it. Like, I'm not like, for me, it's point A to point B.
Yeah.
Whereas some people, it's like the whole experience, and it's like, that's cool. I get that there's things that, we're different, but yeah, that's probably the only one that I can think of off the top.
And I guess if you're saving money in certain areas, it doesn't matter in other areas. Meaning, like, maybe you're a car guy and you just have to have the latest and greatest, but everywhere else you're really frugal and you're really buttoned down and you have a budget for everything. Where I'm the opposite. It's like, if there's a food that I want, if I go out to eat, I'm going to get whatever thing I want. I don't look at the menu and go, oh, this is 14, this is 24. I'm gonna get the $14 one. No, I don't go out to eat a lot, so I get whatever I want on the menu, regardless of price. Whereas in a car is something I would never buy a new car because of the cost differential I can get with a used car.
Right. And I try to also remember, like, because like we're fitness people. For some people, they probably think it's crazy. Like, and I'm sure you have friends like this. Like, they spend hundreds of dollars, multiple gym memberships, like all this stuff. So some people are like, oh my God, you spend more than a car payment on like 2 or 3 luxury gyms in the area. And we'll do it all day long because we're like, yeah, like this gym's for content, this gym's for this gym's for whatever. Whereas the average person, like, if I spend more than $10 at Planet Fitness, that's too much. So I get that it's like different strokes for different folks.
Well, I will say this on a car, it could go either way. So I had a client of mine, I won't say their name, but they're a successful business owner, and they had a very, very nice, expensive car that did not break the bank for them at all. And they sold it. And now they drive an older minivan around. And I asked why. No kids left in the house either. So the minivan's mostly just to, just so you can load it up and stock it with stuff. And they said they were getting a lot of snippy comments from people, because they're in a business in which people have to pay them, about how much money he or she potentially makes because of the car they drive. And maybe in some industries it's good, like the real estate industry, because it shows that you're a good real estate agent, you're selling a lot of houses. But in other industries, in this particular industry, I'm not going to say, it wasn't good for my client, because people were almost like reluctant to pay them, because they go, oh, you already make so much money, why do you need this little amount of money from me for this service?
That makes sense. Yeah. Like, again, like in my opinion, the car is a utility. So, like, I've had people say, yeah, you should drive a nicer car, it'd make you look good. And I was like, yeah, but I mean, the vast majority of what I do is virtual. So I'm like, it's very rare that people even notice that. I mean, I think my car is nice, but it's definitely not super luxury.
All the people I know who are best with their money and who are frugal drive shitty cars. It's everyone, right? This isn't just a one-off. Like everyone I know who is either some sort of like someone who is in the space of money. Maybe they're an accountant for a particular company. Maybe they're a CFO. Maybe they're just someone who makes a lot of money, but they're frugal. They all drive not very nice cars, and I think there's something to be said about that. The fact that that's the case.
I have a former client. He passed away. He was in his 80s. And I really like talking to him because I feel like his mentality is so like the key to wealth. He had a net worth, I don't know, 14, 15 million. His dividend income alone from his stock portfolio is $500,000 a year. Just the dividend income, regardless if the stocks rose or fell. We were having lunch or dinner one night, and he was like, I want to buy myself a new car. Grant, this dude's like 83 years old. More money than he could ever spend, more income than he could ever need. He's like, I want to buy a new car, but I feel really guilty doing it. And it's like he could buy his car in cash from like 1 month worth of his dividend checks. But in his head, he's like, I shouldn't do it. I don't need it. And so like that always stuck with me because I was like, this dude is why. Like there's a reason he has like this huge net worth, because these are the math decisions he's making when he's like, I'm like, you could buy a new car every month and you would still die a millionaire. Yeah. So that always stuck with me.
And I see that too. And I've seen that with clients over time. I will say there comes a point of where that's not great, where it's diminishing returns. It's like, well, you don't necessarily also want to die at 85 with, $140 million in your bank account. It's like you should have lived a little bit and spent that money along the way. So, okay. So what about conflicting goals? I'll give you time to think about it while I give you sort of an explanation about conflicting goals. Sometimes I have clients come to me and go, hey, I want to lose 15 pounds. And I want to put on 10 pounds of muscle. It's like, well, that means if we're going to lose 15 pounds, the easiest way to do that is to cut your calories. If we want to put on all this muscle, it's very difficult to do if we're cutting your calories. So we either have to separate these goals or we have to do one and then the other. Like we can't do both of these goals at the same time. Do you have that in finance, or do you see that just in the general public where they're doing things that they say they want to do, but they're just too naive and they're making a mistake?
Yeah. And that's why we try to bring it back to a goal that's bigger than the goal they hired us for. So for example, we try to push past like, oh, well, I want to make a lot of money. It's like, well, okay, for why? Like, what is that money going to do? Like, what is it buying you time? Is it buying you resources? And that's what we try really hard to like kind of leave the business side and get more back to the wealth management side, where it's like, what are we doing with this money? Because that ultimately will help answer the question when they get very in the weeds with like, what do I do with this decision? Because the best analogy I always use is like a parent who's got young kids and like, I want to spend time with my kids while they're young. It's like, okay, well, you just said what are we going to allocate this profit towards? You could put it in your 401k that does nothing for your kids while you're young. You could hire someone. Okay, that's a potential situation because now maybe you have more time to spend with your kids. Or you could take that money and go on like a cool vacation with the kids while they're young, like Disney World or something, so like, that's why it starts to like whittle us back to like, what are you actually trying to do? Because if you have like a goal that's really like the real goal, that usually will drive the decision, because it's very easy for clients to get like in the weeds with like, oh, I want to make more money and I want to take this tax deduction. I want to do this. It's like, well, what are we doing this for? And so that's usually how we try to like break the tie. Just push them all the way back to like, what's the real reason you're doing this?
Yeah, I think that's a great explanation. When you brought up the parent who wants to spend more time with their kids, their first inclination might be, hey, Pat, I got to make the most money I can to deal with the situation. And you're thinking, well, no, actually, maybe we just want to make sure that your business is really stable so that you can step away from the business, right? So you don't have to worry about getting calls all day long. Your business is up and running, and it could just basically run on its own. You could hire some employee for $14 an hour and it's stable. Whereas if your goal was to make this most money, it would actually be us opening up a second business. And that would mean more of your time.
Right. That's usually where, again, we'll let the client remind themselves what they're actually trying to do. Like, for example, we'll have clients trying to like spend money on certain things. and I'll zoom back to like the goals. Like, you wanted this amount of money, like, so you can sleep at night, like this as a cash reserve. Now you're trying to spend it. So like, do you no longer have that anxiety at night? If the answer is no, like for whatever reason you don't have that anymore, cool, let's spend it. But you told me this is like keeping you up at night. So we finally have this pot of money. Should you still spend it? And I put the onus on them. Like, again, I don't tell them what to do with their money. I just remind them what they told me.
Pat, this has been great information as usual. Why don't you direct my audience or listeners to where they can find more about you and your businesses?
Absolutely. So I'm pretty active on Instagram at the Pat Darby, same handle on TikTok, but I'm more active on Instagram. My website is sincitycfo.com. And those are the three main areas. I have my podcast myself, Build Your Wealth Muscle on all the podcast places. And those are the 2 or 3 main areas.
My guest today has been Pat Darby. Pat, thank you for joining the Trulyfit Podcast.
Thanks for having me.